Hi there. So we're back, and I'm here with David, the David Ingram Show. So we're doing a bit of a role reversal tonight, and we're going to bear down on David to cough up with some of those tax answers that we all want to do and don't want to pay for, right, David?
I'm running and taking off.
So what we want to discuss, or I want to bring to the table here for the next 15 minutes or so, is basically taxation of American retirement programs, beneficiaries of American retirement programs. We'll sort of limit our discussion to IRAs and the like, and rather than get into the many other types of Roth IRAs and traditional IRAs for tonight's conversation, because the topic is so vast that I don't think we have much time to cover much more than that.
Well, let's put it this way again so everybody knows. You're one of the maybe 5 people, only 2 that I know of absolutely, that can sell an IRA or sell an RRSP in Canada. Am I correct in that?
Right.
There's not very many people. How many people do you know other than the work in your office?
I don't know anybody else.
You don't know? Well, I do.
Well.
Daryl Thompson apparently can do it in Toronto.
But basically, so we manage at Seabank Capital, we manage IRAs and Roth IRAs and so forth for...
And RRSPs and TFSAs.
Well, we do the Canadian side, but we manage for Americans resident in the United States who prefer to have us manage their IRAs, or in particular, if they're resident in Canada and need somebody to look after their American retirement program.
And again, the lady that was watching us last week and didn't phone wrote me this wonderful letter saying how thankful she was that she'd logged in and heard the thing, and she was finally, after 5 years, somebody that could answer her questions for you.
Yeah.
For her. And this is
it's hard to find the information.
Well, the information isn't there. Nobody knows.
Nobody knows.
Unless you spill. How long have you spent learning it?
Well, we've been at it for several years now. I mean,
you didn't learn it in a month.
Didn't learn it in a month.
Didn't learn it in a year.
Yeah.
You and I still ask each other questions because we're not sure.
Well, sure. And there's different aspects to it, whether it's the investment aspect or whether it's the tax aspect, or there's just so many moving parts when you're a cross-border type of thing. But for this segment, let's talk about American retirement programs.
IRAs.
IRAs. An IRA is an individual retirement account.
You got it.
The vanilla individual retirement account is what's called a traditional IRA.
$4,000 a year.
You put $4,000 in a year, you can deduct it from your tax, right? As opposed to a Roth IRA.
Yep.
And a Roth IRA is where you
put the money into the account but don't get a deduction.
Right.
But the earnings within the account are not taxable to.
Right.
Which is very similar to that thing that they just came up with.
Which is the TSFA here in Canada.
TSFA in Canada, yeah.
Right. There are different things you can do. You can convert your traditional IRA to a Roth or roll it over, correct?
But if you roll your traditional IRA into a Roth, you have to take it into income over a 5-year period.
Right.
So if you've got $100,000 in a traditional IRA and you want to put it into a Roth IRA and you're in a 28% tax bracket, by the time you finish, you pay $28,000 tax on that, $100,000, and that's maybe not a good idea.
Right. But it can be done, and it is done if it may be to your advantage, but it can be done. I just wanted to cover the basics.
You need a big spreadsheet to figure out whether that's to your advantage. I mean, you tell me what day you're going to die and what day you're going to get divorced and how much money you're going to make in the next 20 years, and I'll tell you exactly what you should do.
There you go. So we have our traditional IRA, we have a Roth IRA.
So you buy a traditional IRA, you deduct it on your tax return.
Right.
Okay.
Can you have 2 at the same time?
Yes, you can.
As long as you don't exceed...
As long as you don't exceed $4,000 a year, or if you're over 50 or 55, I don't know.
Right.
All right. But if you're over a certain age, you can put more in.
Put more in. So let's talk about beneficiary aspects of the American beneficiary system. It's different than Canada.
Yeah.
Is it not? You can, my understanding is you can name your children.
Yes.
And you can roll your IRA down to your children.
Absolutely, because we get kids all the time that are getting that IRA from mom and dad.
Right.
And they've got the IRA, and they're Canadians, and their mother died in Spokane and left her a $27,000 IRA, and now she's got to report it on her income tax return when she takes it off. The daughter reports it, whereas in Canada, the mother reports it on their final tax return.
Right. Let's do the cross-border stuff next. Let's just talk about domestic U.S.
Oh, domestic
Domestic U.S. It's confusing enough as it is.
Right? Well, but then we got to watch out, because But I think most people are watching this are likely going to be.
So they will, but I think we wanted to compartmentalize it a little
Okay.
bit, simply that kind of cover the basics on the U.S. side. What age do you have to take distributions out of an IRA?
Well, I think it's. Well, the rule, there's a 59.5 rule that if you take it out
Earlier,
before
it's a
then, you
penalty.
pay a 10% penalty.
Right.
But I think it's 70, isn't it? 70 or
Right.
71.
Yeah. So then you have to take out X amount of
I
dollars.
never get involved in taking it out. But 70 or 71 is the same, is sort of the same as we've got here.
Similar.
We tried to go, we started off the same, went down to 69, went back up
Right.
to 71.
So that becomes
It's after you're it's the year, you have to, year after you turn 70. I could go look it up, but I'm not going to bother. If you're close there, figure it out first.
Yeah, well, it's we just wanted to cover the basics
Yep.
in terms of the generalities. The specifics we can always address, but
You didn't give me a list of questions in advance.
yeah, I didn't prep him on this. I just
All right.
thought I'd hit him between the eyes tonight. Well,
70.5.
so as far as other retirement accounts, they're similar. I mean, you basically have tax deferred accounts.
Well, you got 403Bs, you got 407Ks.
Right, there's a variety
401Ks,
of very
you got.
But basically, one of the things that I might want to bring up here is that the 40K basically is a company group RSP, as we would
Yeah.
think of it in Canada, correct? Where a company, you join a company contributory retirement program, where you put in some money, company matches it, or so forth. It's a 401K.
Well, that would be a 401K.
401K.
It was a-
When you leave your employer, generally speaking, you
They
have
make
to
you roll
leave.
it over.
They make you roll it over to an IRA.
Yeah.
Correct. And that's a tax-free rollover if you do it within a certain time period. Direct from, you can't take the money out
Has
into
to
your
go
hands.
Straight. Here's the Keogh
Direct.
plan. Here's the
Right.
IRA.
And then it continues on in the IRA and so forth. And
as opposed to Canada, where people are be known to put it into their pocket and then put it back into an
Right.
RRSP.
right. So it has to go direct
It
down
has
there.
to go direct.
So certainly when folks leave a company, and we've been involved in that, whether it's, converting, for example, we often get asked, I've retired or I've got my job, I got retired, and and I've got this 401K, what can I do with it?
Well, and this
So
is where
we roll it, we'll take
Yeah.
the 401K and we'll move it over to an IRA, a self-directed
But
IRA.
you will do that, and I don't care. You can't segment this thing. You will do that for the Canadian that's lost his job or something.
Right.
The money's down there, and he's come back, and suddenly they say, "We can't do this for you. You're going to
Right.
have to." I've had 15 people in the last 2 months tell me they've had to take their money out because
No.
they wouldn't. Well, I know they don't have to,
Yeah.
but they've done it already
Right.
because they were told that nobody would look after it for them.
Right.
In this business of all these layoffs in the States, that's
Yeah.
what's happening to
That's
people.
exactly
So
right.
again, if you or your friend or your cousin, your mother, your best friend, your worst enemy, some guy you met down the street or you met on a BC ferry or a hockey game, Dan can do that for you.
Yeah.
Or your brother or
So
something.
just to reiterate, if you retire or are exiting your job, whether it's you're laid off or you quit or whatever, and you have a 401K, and you're between jobs or you're coming back to Canada, you do not have to cash that in and pay the tax on
No,
it.
but again, remember that if you're in the States, there's no problem because the
Right.
guy just looks after you.
Right.
But if you come back to Canada,
Right.
nobody wants to deal with you.
Right. Well,
And
that's true.
That's what we're talking about.
Exactly.
Is the guys that are coming.
Yeah.
Now, if it's only $4,000 or something, it's
Yeah.
not worth getting involved
Well,
in
that's
what
right.
you're doing. That's it. But
Right.
if a guy's got $150,000 or $200,000 and he suddenly has to take out and pay tax,
Well, often what will
And a
happen
penalty.
is most people down there will have a 401K and they'll have an IRA.
that's right.
So one will be at a fund company, say, which would be, say, Fidelity or Vanguard or something like that, plus they got the 401K, but they can't, because they're coming back to Canada, they're hooped on both fronts,
Yep.
right? They can't roll the 401K into a Fidelity because their address has changed, and so it's a double header.
Yep.
So what we could do is we basically set up a self-administered IRA. We move the IRA, the existing IRA, into it. Plus, we just drive the 401K proceeds right into the new self-administered IRA and tidy it all up. And you as an individual can then control the distribution or dissolvement of that IRA over time.
Then you can roll your Keogh into a Canadian RRSP.
Sure.
It's a little involved.
So let's move on to the cross. Since we're just drifting into the cross-border side here, let's just continue on.
I'm going to stay away from cross-border.
Let me put this one to you. This is a question I was asked here the other day, and I think that we need clarification here. Canadian in the U.S. for a sustained period of time as a professional decides to retire back to Canada, has a substantial plan, 500,000 plus, and moves back to Canada. He's a dual citizen.